I just watched Brian Kim's latest video on ClearValue Tax, and honestly, I agree with some of his points. But there is one big problem. The title says Americans are burning through their savings. After reading the actual GDP report myself, I don't think the data support that conclusion. So instead of reacting to the headline, let's go through the numbers point by point. So, Brian, I watched your full GDP video, and honestly, I agree with some of your points, but I think your title and your conclusion go much further than what the actual data shows. So, Brian started by saying GDP came in weak. That is true. The market was expecting around 2.0% to 2.1% growth, but the official numbers came in at 1.5%. So, yes, the headline missed expectations. No doubt about that. But as an investor, we cannot stop at the headline. A weaker GDP number does not automatically mean the economy is falling apart. If you actually read the report, the weakness did not come from consumers spending less. It came from weaker net exports and lower business inventories. That is a very different story from saying the American consumer is weak. Real investing starts when you look beyond the headline. Brian also spent a lot of time to talking about the falling saving rate. And yes, he's right about the trend. The personal saving rate has dropped at around 2.7%. But saying the Americans are running out of money just because savings are low is a very big conclusion. Why? Because a low saving rate does not always mean people are running out of the cash. First, look at the wealth effect, guys. Many Americans have seen their stock portfolio and home value go up. When people feel wealthier, they usually save less cash and spend more. Second, look at the real wages. Recently, wages have been growing faster than inflation. That means people still have real buying power. And finally, look at corporate cash reserve. Many US companies are sitting on a huge amount of cash. As long as companies have cash, jobs stay safe. And as long as people have jobs, they keep spending. Now, here's something Brian explained it well, but I think it needs more context. US tech companies are importing a huge amount of AI hardware right now. We are talking about billions of dollars worth of chips, servers, and networking equipments. In GDP calculation, higher imports reduce the headline GDP number, but economically, those imports are not a sign of weakness. They are investments for future growth. Microsoft, Meta, Google, Amazon are spending hundreds of billions of dollars building AI infrastructure. So yes, it looks negative in the GDP report, but in reality, companies are investing heavily for the future. Look, titles like this create fear. They do not create clarity. Cloud consumer become weaker later? Yes. Cloud, a low saving rate become a real problem in the future? Of course. But this report does not prove that America is running out of money. In fact, the same report shows that consumer spending actually increased by 3.2%. Think about that, guys. Overall GDP grew 1.5%, but consumer spending grew 3.2%. That tells us domestic demand is still very strong. The real question is, can income growth continue supporting this spending over the next few quarters? That is the number we should watch, not just a catchy headline. So, guys, I just want to say this. Brian made some good points. GDP slow down, savings are low, and yes, we should keep watching the consumer. Where I disagree is turning these normal economic changes into a dramatic story. Good investors do not make decisions based on emotions. They look at the real data underneath. This is how you avoid panic selling, and that is how you make smart long-term investment decisions. So what do you think, guys? Is the American consumer really in trouble, or is this just a normal economic shift? Let me know your thoughts in the comments. And if you want data-driven market analysis where we challenge headline instead of following them, hit the follow button and I will keep breaking down the market with facts. No fear. See you in the next one. Thank you so much.